The FTSE 100 has tonight closed at a fresh all-time high. It put on 119 points during the day to close at 73.83, adding more than £30 billion to the value of its constituent companies. Much of the reason for that was the dollar strengthening after President Trump's first speech to Congress last night. And that has also helped markets in the US, with the Dow climbing through the 21,000 barrier today for the first ever time, just 6 weeks after it closed above 20,000 for the first time. Well, Tom Stevenson is the investment director at Fidelity International. So, Tom, how much of this is down to the Trump effect in that speech last night?
Well, I think quite a lot of it is down to the exchange rate. The dollar's rising, the pound is weakening, and that's good news for the FTSE 100 because the FTSE 100 is a very international index. Something like 70% of the earnings of FTSE 100 companies are made overseas. So a weaker pound makes our exports more competitive, and it makes the overseas earnings of those companies worth more when they're translated back into sterling.
And all those big dollars were the big gainers today on the FTSE, the likes of HSBC, Glaxo, BP, Shell, and so on.
That's right. I mean, the FTSE 100 is particularly exposed to those kinds of dollar-sensitive stocks. But there are other factors at work as well. I mean, the banks were very strong, and that's in anticipation of rising interest rates. Rising interest rates are good for banks because they make their profits on the difference between the price at which they lend and the price at which they borrow. So rising interest rates good for them.
Absolutely. I mean, this has been the moment really that the banking sector has been waiting for since about 2009. I mean, is a rate rise from the Fed nailed on this month? I mean, there's a lot of indications that it's coming.
Yes, I mean, I think it is almost nailed on. The odds, gleaned from the futures markets are saying that there's something like an 85% chance that we will see another quarter point rate rise from the Fed on the 15th of March in a couple of weeks' time. Now, that's risen from maybe 40% only a week ago. So really, people are getting more and more convinced that there will be a rate rise soon.
But what about traditional investment yardsticks, Tom? I mean, earnings growth traditionally is what underpins stock prices. On historic levels, by some measures, stocks are pretty expensive. Is earnings growth keeping up with, is it justifying these kind of moves?
Well, that's the key question for investors in 2017, is whether the earnings growth is going to come through to justify what in some cases, and particularly in America, are pretty punchy ratings at the moment. Something like 19 or 20 times earnings, which by historic measures is pretty high.
Yeah, traditional historic average is about 15 times, isn't it?
Exactly. So they are quite expensive by historic measures. But what we've seen this quarter, the earnings season that we saw, particularly out of America, pretty strong. Earnings growth of maybe about 4.5%. We had earnings growth of maybe 3% in the last quarter of 2016. But before that, we had 5 quarters of declining earnings. So there's been quite a turnaround in corporate earnings.
But of course, all of that would be impetus for the Fed to raise rates.
Yes, it would. And I think, the Fed is looking at the strengthening economy, it's looking at the jobs figures, it's looking at what maybe it can expect from a Trump presidency, and really it's concluding that it needs to raise interest rates pretty soon.
And it's worth pointing out, of course, the dollar has been strong not only against sterling today, it's been strong against Japan, the euro, the whole basket of currencies.
It has, and that's good news for markets around the world, actually. I mean, you mentioned Japan there, but I mean, a weakening yen is very good for an export-heavy market like Japan. So the Japanese market also rose today.
But I mean, what's underpinning these earnings that we're getting out of the States? And indeed, I mean, in the UK, it's fairly straightforward. I mean, we're seeing them, for example, we had GKN yesterday flattered to an extent by the strong dollar. Is there genuine prosperity emerging in the US from a result of this?
Well, I think there is, and the interesting thing is that this process was underway even before Donald Trump won the presidency. So this has been going on really for 6 or 9 months, this improvement. As I say, the jobs market is improving, people are getting more confident, consumers are getting more confident, the housing market is picking up. So I think there is a genuine improvement in the outlook for companies.
The irony, of course, though, is that that doesn't really seem to be coming down onto Main Street, which is one reason a lot of people say why Trump was elected.
Well, that's right. I mean, he was elected precisely on that mismatch. And I think that, what we need to see is an increase in wage inflation for that shift from the corporate sector getting all the gains to Labour getting all the gains, that Main Street, as you call it.
Now, lest we forget, Tom, stock indices were also pretty strong in mainland Europe today. The CAC in France was up by 2%, the DAX in Germany by 1.5%. What's the earnings picture been like in the Eurozone thus far?
Well, interestingly, investors are getting more and more enthusiastic about European stock markets as well. And that's despite, of course, all the political uncertainty which we've got coming up with elections in Holland and France and Germany later in the year. And the reason why they're getting more enthusiastic is that the earnings picture in Europe too is also improving.
And also the underlying picture in the Eurozone economy is getting better as well. I mean, we're seeing some solid manufacturing data, for example.
Yeah, I mean, the engine room of the European economy is obviously Germany, and the figures that we're seeing coming out of Germany are really quite encouraging. So I think the interesting thing will be to see how the European Central Bank responds to that, whether they start tightening policy as well.
All right, Tom. Well, thanks for the moment. We can bring in now from Wall Street the Fox Business presenter, Laurie Rothman. She's at the New York Stock Exchange. So, Laurie, what's the mood like in New York at the moment? Is this a bit of a bubble, or is there genuine sense that there's proper growth coming underneath all this?
So it's lovely to be with you. Yesterday, there was some concern. It was a big pause here for U.S. markets, awaiting President Trump's speech before joint session of Congress last evening here on the East Coast in Washington, D.C., of course. And there's not only a sigh of relief, but President Trump delivered more than what Wall Street was even anticipating with his promises for tax reform, rollback of regulation, of course, infrastructure spending. And what's key here is that's not new, but he really drilled down on it. So now that we've moved past that, the market, all the gains that we've seen since Election Day here in the U.S. last fall, according to Wall Street, the folks here I talk to every day, they say those gains are justified, and so they're adding some more. In fact, for the Dow Jones Industrial, I'm glancing up right now, with a gain of 307 points. I mean, these are all-time highs. You've got 21,119 on the Dow Jones Industrial Average. That's a benchmark that follows 30 stocks from a broad range of sectors. And this, if we do close above 21,000 today, it will be the quickest 1,000-point gain. Actually, it'll tie the fastest pace ever in all of history. The broad market average, the S&P, is up as well, over 1.3% today. Since President Trump won the surprise election here in the U.S., the Dow, going back to the industrials, has gained 2,600 points. That's a gain of more than 14.5%. So the statistics are just staggering.
Laurie, after the market shuts tonight, the Snap IPO prices.
Yes.
Is this going to be a Facebook situation where the stock went to the moon, or is it going to be a Twitter and disappoint everyone?
Well, you know, the timing for Snapchat, let's keep the broad picture in mind. The timing really couldn't be better with so much bullishness circulating and surrounding U.S. markets right now in the U.S. economy. Snapchat looks to go off better than expected. Analysts were first looking for a pricing of a range of $14 to $16 a share. They say that could come up to $17 to $18 a share, which would value Snapchat something like $25 billion U.S. dollars, and could really resuscitate what's been here in the U.S. a very dormant tech IPO market.